Today's topic of discussion from Strategy Stratum is about looking at investment funds which make an impact and make money. Often combining these two mandates pits fund managers against competing objectives, but that is not always the case. We're going to look at some funds which do both good and perform well. More specifically, we're going to look at the strategy behind the success of these funds and see how they are making a difference in the entrepreneurial landscape for minority-owned businesses. What we know from the start is that despite contributing over $1 trillion to the U.S. economy, minority-owned businesses consistently face funding gaps, often denied capital due to what some would say are systemic biases. But we also note that there's a growing movement of investors actively working to dismantle barriers, not just as a social good, but as a strategic economic imperative. As noted a moment ago, the funding gaps experienced by minority entrepreneurs represents a major economic inefficiency and a barrier to broad-based prosperity. A crucial factor highlighted in this analysis is the intentionality and diverse leadership within sampled funds, which addresses systemic biases in traditional finance. At the same time, despite successes, challenges persist, including deep-seated systemic barriers to capital, limitations on traditional investment pipelines, difficulties in measuring social impact, and fundraising hurdles faced by diversity-focused funds themselves. Addressing these issues requires collaboration from investors, policymakers, and the financial community to foster inclusive and widespread economic growth. Impact investing aims to achieve financial returns and positive social outcomes, challenging traditional views that social issues are solely the responsibility of government or philanthropists. This emphasis on impact investing signifies a move towards addressing specific, historically marginalized groups and inequalities, and helping to make equitable outcomes a central part of the definition of impact. Minority-owned businesses make up about 30% of all American businesses and employs 7 million people, generating $1 trillion in annual revenue. Their contribution, of course, is vital for strengthening communities, reducing wealth gaps, promoting community development. One example of such funds is the Boston Foundation's Business Equity Fund, which aims to cultivate a thriving entrepreneurial class among minority economic groups to generate opportunity and wealth within their respective communities. Minority businesses, despite being 30% of the economy, receive less than 3% of venture capital. So investing in these businesses is a strategic imperative to unlock untapped economic growth potential. Regarding the persistent funding gap, the Federal Reserve's 2023 Small Business Credit Survey report noted that 41% of African American owned businesses were denied loans, compared to 18% of white owned business owners. The venture capital landscape shows even greater disparities in that regard. In 2022, African and Latino founders received only 1% and 1.5%, respectively, of total U.S. venture capital funding, with their female counterparts receiving a mere 0.1%. This inclusive investment ecosystem, though, features diverse models, including philanthropic foundations such as Greater Milwaukee Foundation, specialized venture capital firms such as Backstage, Harlem Capital Partners, Debut Capital, and government initiatives such as Minority Business Development Agency grants. Foundations often use loans, equities, and guarantees, recycling financial returns into new projects for sustainable community benefit. The success of these varied models demonstrates that addressing the systemic funding gap requires a multifaceted collaborative approach. No single capital structure can fully resolve the complex challenges faced by diverse entrepreneurs, and this point highlights the need for interconnected ecosystems that meet the diverse needs of minority businesses. Back to the example of the Boston Foundation's Business Equity Fund. This particular fund offers low-cost loans and equity investments up to $500,000 to minority-owned businesses with over $250,000 in annual revenue. The BEF operates as an evergreen loan fund, reinvesting payments to create a continuous capital cycle. Another example, Greater Milwaukee Foundation's impact investment generates financial returns also for reinvestment. Corporate programs like Morgan Stanley Inclusive and Sustainable Ventures, MSISV, offer direct equity investments and grants tailored to different organizational structures. These nuanced approaches address specific capital gaps such as lack of collateral or need for early stage risk capital. For regarding comprehensive capital building, financial investment alone is often insufficient to achieve business development objectives. So therefore, successful funds pair capital with robust non-financial support, recognizing that funding gaps are often linked to knowledge and network gaps. The Business Equity Fund, for example, provides ongoing support, and the MBDA's Capital Readiness Program offers technical assistance for growth and scalability and other issues faced by small-scale entrepreneurs. Mentorship and networking are also crucial in these and other programs. So, for example, Morgan Stanley's MSISV programs connect organizations with mentors, entrepreneurs and residents, and advisors, providing access to powerful networks within Morgan Stanley and the broader investor ecosystem. Backstage Capital is another example, offers mentorship, fundraising assistance, and community integration into its portfolio companies. Debut Capital, another great example, provides hands-on guidance and product strategy, MVP or minimum viable product development, hiring, and scaling. Some of these initiatives also offer entrepreneurial curricula and workshops through MBDA grants and helping to equip students and uh, business owners with management skills. So why are these programs so important? As the key here and what makes this approach so interesting is that having this holistic approach addresses exclusion by providing social capital and expertise at the same time, of course, with the aim to build enduring and sustainable capabilities within the company over the long run, and also helping to integrate minority businesses into broader economic networks to help improve potential for success over the long run. So, more than just networking, the secret sauce behind successful impact funds is their focus on actively building and nurturing ecosystems. So, the Business Equity Fund is part of a broader ecosystem in Greater Boston, including the Business Equity Initiative and the Greater Boston Chamber of Commerce Pacesetters Initiative, which all of which provide capital, capacity, and contracts. The Greater Milwaukee Foundation's Impact Investment Program, for example, focuses on economic building blocks like small businesses, housing, and early childhood education, exemplified by investments in Thrive on King development and Thrive on small business loans. Another example is the American Heart Association's Social Impact Funds, which leverages their brand, expertise, and network to align funding with community needs in healthcare, food security, and economic empowerment. So this ecosystem approach acknowledges that challenges are multidimensional, requiring coordinated efforts across financial, educational, market access, a wide range of areas for, in order to enable sustainable wealth creation. Another key characteristic of successful inclusive investment funds is their explicit intentionality and diverse leadership. So many decision makers, for example, for the Boston Foundation's Business Equity Fund, have direct entrepreneurial and investment experience. Research supports that Black investment team leads narrow the funding gap for Black founders by nearly 50% by relying less on traditional, potentially biased signals, as they say. Similarly, VC firms with female partners are more likely to invest in female founders. This emphasis on diverse leadership is a strategic advantage, enabling more accurate pattern recognition for success in these underrepresented markets. Otherwise, the pipeline problem, often cited for the scarcity of diverse founders, is fundamentally a network and perception issue within the investment ecosystem. As mentioned earlier, many VCs rely on founder pattern matching, seeking narrow characteristics like Ivy League education or prior success startups, and this leads to a leaky pipeline where initial funding disparities can worsen over time. We all know that networking is absolutely essential to entrepreneurial success. A significant barrier is the reliance on warm introductions. for as many as estimated 82% of venture deals. Female founders, for example, are 38% less likely to have direct connections to venture investors. So there are a few learning points from this analysis into impact investment. These would apply to investors and fund managers and those looking to expand the effectiveness of these and similarly mandated social impact investment structures. So the first of these is to prioritize diverse leadership and investment teams. As noted earlier, diverse management teams are more likely to fund diverse founders and bring in different networks and evaluation criteria that can counteract traditional biases. Second approach is to adopt tailored capital solutions. So implementing a range of financial instruments, including low-cost loans, patient capital grants, and flexible equity investments, for example, can go a long way towards matching the varied needs and stages of minority-owned businesses. Third approach is to integrate comprehensive capacity building. So pairing financial investments with non-financial support, such as mentorship programs and strategic planning assistance or product strategy support, financial management, legal guidance, and many other types of support to ensure regular and frequent networking opportunities are available to all business founders and the wider business ecosystem. So finally, a robust impact measurement system is also needed to be put in place. All of this analysis is well and good, but its continued success will hinge on effective defining, tracking, and validating the outcomes. There is a lack of universally accepted metrics and methodologies for measuring social impact. And as we know, social issues are complex and influenced quite often by external factors, making it hard to isolate the impact of the intervention. A Wharton study found that while impact funds market their social mission more, their internal practices prioritize financial expertise. This sort of internal tension then can make social agenda a secondary objective. So with that in mind, impact funds must implement some sort of measurement framework, tracking not only job numbers, but also metrics such as economic security and skills advancement and long-run success of businesses to reflect these deep-level changes and economic growth across communities. So the process for investors to find, decide on, and eventually exit an investment typically involves a few distinct phases. The first of which is finding investment targets, deal sourcing. This step begins with reviewing applicants or pitches submitted by founders, looking at specific characteristics such as the founder's vision, resilience, and commitment, and assessing the industry opportunities. So this is where diverse leadership of an investment fund comes into play, with key decision makers being inherently open to seeking opportunities in diverse communities and in understanding their context, challenges, and strategic approaches for success in the marketplace. So the second part is investment decision making. Once a potential target is identified, investors move into a more rigorous evaluation phase. This step includes introductory meetings and due diligence and internal reviews where the investment team collectively makes decisions about next steps. So funds typically look for scalable companies with significant return potential and, of course, a strong founder product fit. So in this way, tailored capital solutions are essential to consideration at this phase, ensuring that the entrepreneur obtains the maximum value input from the investment, but without the burdensome obligations that will hinder long-term wealth creation by the founder. When it comes to business growth, in this stage, the investment fund can bring substantial value to the business through, as noted above, comprehensive capital building as part of the investor's responsibility to its investee companies and to help maximizing opportunities and optimizing their investee company potential, though through mentorships, networking support, and other strategic and personnel development activities. Finally, when it comes to the exit, the ultimate goal of most investment funds is to sell the position at a higher value to realize a profit. Also, as noted above, this objective is not the only one. Developing effective impact investment programs will pivot around the insights that investors have into the overall effectiveness of their programs. So being able to do that, of course, requires that attention be given to the metrics which go beyond mere financials, but also considers the social impact and how that business plays into the community. And of course, developing these metrics is quite a significant challenge to make them actionable, meaningful, and objective. So this discussion has delved into the world of investment funds with a social agenda and with the mandate to empower and build businesses among minority groups. There are some key questions that investors and entrepreneurs themselves can ask to help ensure that continued success and development of the small business ecosystem. So first off, how can we proactively diversify the deal flow and internal investment teams to counteract systemic bias and to identify high potential minority entrepreneurs? So this question addresses the persistent challenge of networks in traditional finance and focuses on intentionally seeking out minority-owned businesses and ensuring diverse representation within the decision-making ranks of investors. A second question I would say is, beyond providing capital, what comprehensive, tailored capacity building support and ecosystem development initiatives can we integrate to foster sustainable growth and resilience for minority-owned businesses? So financial investment alone is not sufficient to achieve social mandates. Therefore, successful funds will need to combine capital with non-financial support like mentorship, technical assistance, and access to business networks. So this question also speaks to the importance of actively building and participating in broader support ecosystems and collaborating with other organizations with the aim to provide a holistic suite of resources, including capital, but also access to more value-added contracts. And a third question I think is key here is, how can we develop and implement rigorous, transparent, and long-term impact measurement frameworks that go beyond traditional finance metrics to validate and communicate the social transformation these impact investment funds are creating? So understanding this question, I think, helps to avoid impact washing by pushing funds to define, track, and validate their outcomes in a broad context, and to ensure transparent reporting to build stakeholder trust. So there's so many interesting areas to unpack in this analysis, and I hope you have found this discussion to be interesting and, most importantly, meaningful input into further action towards making the investment community one which extracts the greatest value in all shapes and sizes of new opportunities from entrepreneurs of all social and economic origins. So with that in mind, I look forward to hearing any feedback. And now we're at the last slide. Have a great day ahead. Cheers.